Good morning. Grab your coffee, take a seat, and let's look at your screen, or rather, your 401k statement. If you've looked lately, you're probably feeling pretty good. The S&P 500 is hitting record highs, and your portfolio is riding the back of a green giant called NVIDIA. It feels like we're in the middle of a golden age, a new industrial revolution powered by silicon and algorithms.
But here's the deal. Behind that shiny facade, there's a number that keeps me up at night, and it should probably keep you up too. That number is $840 billion. According to a recent update from Sequoia Capital, that's the AI revenue gap. Here's the math. The tech industry is spending roughly $840 billion on hardware, data centers, and electricity to get this AI revolution off the ground. But how much are they actually making from selling AI software? About $40 billion. Let that sink in for a second. We are spending nearly $1 trillion to generate 5% of that in actual revenue. It's a massive disconnect, and it's the biggest question in global finance today. Now, you might be thinking, hey, it's early days, the revenue will come. And sure, that's the bull case. But look at the concentration. The Magnificent 7 tech stocks now make up 31% of the entire S&P 500 index. That is a historic level of dependency. If you own an index fund, you aren't just betting on the US economy anymore. You're betting almost a third of your life savings on a handful of companies solving that $840 billion puzzle. And this is where the story takes a turn. If the world isn't actually buying enough AI software to pay for the chips yet, where is all that record-breaking revenue coming from? Well, that's where things get interesting. Okay, let's talk about the round trip. It sounds like a travel itinerary, but in the tech world, it's a high-stakes shell game. Imagine you own a restaurant. Business is slow, so you give your friend $100 and tell him, go buy a steak at my place. He does it, you record $100 in revenue, your investors see the growth and buy more of your stock, but did you actually sell anything? No, you just moved your own money in a circle. That, in a nutshell, is what we're seeing in the AI ecosystem right now. Here's how the mechanism works in the real world. Tech giants like Microsoft or NVIDIA invest billions of dollars into AI startups. Think OpenAI, CoreWeave, or Mistral. But there's often a catch. That investment capital is effectively earmarked. The startup gets the cash, and almost immediately, they hand it right back to the lender to buy chips or rent cloud computing space. It's called vendor financing. It's not an organic sale, it's a loop. And the scale of this flow is estimated to be between $50 and $70 billion already. That's a 400% jump in just 3 years. When NVIDIA reports a blowout quarter, or Microsoft shows massive cloud growth, you have to ask, how much of that is organic demand from companies actually using AI to make money? And how much of it is just the round-trip loop? The data on AI startups is even wilder. The average burn-to-revenue ratio is now 12-to-1. That means for every $1 these startups make in revenue, they are spending $12 on compute. It's like a business spending $120 on electricity just to sell a $10 pizza. The math stops working, and when math stops working, economists start sweating. So why do it? Because it triggers what we call multiple expansion. If a company shows 100% revenue growth, investors are willing to pay a much higher price-to-earnings ratio for the stock. The loop creates the appearance of hypergrowth, which drives the stock price up, which increases the company's market cap, which forces your 401k via those passive index funds to buy even more of the stock. It's a self-reinforcing cycle. But here's the part I find wild. Who is actually pocketing the cash while your retirement fund is being locked into this loop? This is the part of the story nobody's talking about, the hidden beneficiaries. While the public is busy debating whether ChatGPT is going to take their jobs, a very different group of people is getting very rich, very quietly. I'm talking about private credit funds. Firms like Blackstone and Magnetar Capital have allocated over $10 billion each to AI infrastructure debt. This is a brand new frontier. They aren't buying stocks? They are lending money to these startups, and they are using the GPUs themselves, those H100 chips, as collateral. This is asset-backed lending for the Silicon Age. And here is why they love it. They earn high interest regardless of whether the startups actually succeed. If the startup goes bust, the private credit firm just takes the chips and sells them to the next person in line. It's a heads I win, tails you lose scenario. Meanwhile, tech executives are exercising their stock options at these peak valuations, valuations that are being propped up by the very round-trip revenue we just talked about. It's a fascinating disconnect. The risk is being socialized into your 401 keel through index weighting, but the profit is being privatized by the people sitting at the top of the pyramid. We're also seeing a new trend called tokenized debt issuance. Tier 2 cloud providers are actually using real-world assets to fund their chip clusters. It's a global web of debt that is expanding at a breakneck pace. Private credit tech lending is now a $100 billion market, up 350% in just a few years. It's a massive bet that the music will never stop. But history has a funny way of repeating itself. Is this a groundbreaking new economic model? Or are we simply watching a high-tech remake of a 25-year-old disaster? Let's zoom out for a second and look in the mirror. If this all sounds vaguely familiar, you might be remembering the year 2000. Back then, the OH-100 of the era was fiber optic cable and networking gear. Companies like Nortel and Lucent were the kings of the world. Their stocks were in every retirement account, and they had a very similar strategy. They lent billions of dollars to fledgling telecom startups so those startups could buy Nortel's equipment. It looked like infinite growth. Until it wasn't. When those startups couldn't find enough customers to pay for the bandwidth, they defaulted on the loans. Nortel didn't just lose its customers, it lost its revenue and its investments all at once. The company collapsed into bankruptcy, and it took a huge chunk of the Nasdaq with it. The similarity between the Nortel scandal and today's AI vendor financing is, and I don't use this word lightly, staggering. We're looking at a 90% match in the underlying mechanism, but there's a key difference this time that makes it even trickier: the scale and the physical requirements. AI doesn't just need capital, it needs power. Massive amounts of it? We are looking at a projected electricity demand of 1,000 terawatt-hours by 2026. That's double where we were 3 years ago. It's like adding another entire country's worth of energy consumption to the grid just to keep the chips humming. The IEA is already issuing warnings about grid stability. So we have a system where billions in debt are being used to buy chips that require billions in energy infrastructure, all to generate software revenue that hasn't showed up yet. In the 2000s, the fallout was sectoral. It hit tech and telecom. But today, because the Mag 7 is so deeply embedded in every index, the potential fallout is systemic. This isn't just a tech bubble, it's a valuation trap that has wrapped itself around the entire S&P 500. As we approach what I call the raw or all-raw wall in 2026, the question isn't if the loop will snap, but how the average saver is going to handle the recoil. So what does this mean for you? Let's get pragmatic. The average 401k now has about 22% exposure to this specific AI vendor loop. That's nearly a quarter of your wealth tied to the hope that these startups can pivot from burning cash to making profit before the debt runs out. We call this the ROI wall. Sometime in late 2025 or early 2026, the venture debt will need to be refinanced. If these AI companies haven't found a way to solve real-world problems cost-effectively by then, the round trip stops, and when the revenue growth disappears, those massive stock multiples will come crashing down to earth. Now, I'm not saying the sky is falling. Jensen Huang at NVIDIA argues we are at the start of a new industrial revolution, and maybe he's right. Maybe these data centers are the AI factories of the future. But as a listener, you need to be an active observer, not a passive passenger. Next time you see a tech earnings report, don't just look at the beat. Look at where the money is coming from. Are they selling to real businesses, or are they just selling to their own investment portfolio? Check your quarterly statement. If your exposure to those top 5 tech names is over 30%, you aren't diversified. You're concentrated in a circle. The AI revolution may be real, and it may change the world. But when a system starts selling to itself just to keep the lights on, it is usually the people in the back row who end up paying the bill. Stay sharp, keep an eye on the data, and I'll see you tomorrow morning.